Benjamin Graham concludes that the margin of safety is the cornerstone of investment success. From this book right here, Intelligent Investor. It's chapter 20 of this book, and it's one of the chapters that Warren Buffett considers the most important.
He said always have a margin of safety. Leave yourself some room for error because you don't know everything.
So why should you understand this concept? If you buy a stock with a margin of safety, you significantly reduce your risk. This is why it's so important to pick stocks with a margin of safety. Now imagine this. Let's say you're buying a second-hand car and you're quoted rupees 4 lakhs. You compare other similar cars online with other car dealerships and you learn that it's actually worth 6 lakhs. You're not able to find a similar like-for-like car less than 6 lakh rupees. So the difference between what you paid, 4 lakhs, and its intrinsic value, 6 lakhs, is the margin of safety in that purchase. So the margin of safety gives you a cushion for unexpected outcomes. So in the example that I shared, imaginary example, if you went ahead and bought this car and a week later the brakes went out and you had to spend 50,000 rupees to fix this car, then you're still not at a loss because the car is actually worth 6 lakhs. So you have that cushion, that margin of safety. So let's translate this to stocks. Let's say you believe a company is truly worth 1,000 rupees per share, but you get it for 500 rupees. The difference of 500 rupees is your margin of safety. So the margin of safety protects you from the erosion of your wealth. And it's important because we have a tendency to make mistakes as human beings. So factoring in a margin of safety protects you from the possibility of errors that you made in your analysis, in your forecasting with key estimates when you're trying to value a company. The other reason this is important is market volatility, rather. There are ups and downs and there are seasons of highs and lows or a bull market, a bear market. You can't truly predict what's going to happen. So if you have a cushion, you can ride out the volatility that comes with investing in the markets. So how do you calculate margin of safety? Now, there are a number of methods that you can use to calculate a margin of safety. I use a simple one that Benjamin Graham, again, suggests in his book, Intelligent Investor. His formula is earnings yield minus government bonds yield. So, for example, again, using the numbers that I used previously, if a company is valued at 1,000 rupees per share, if its earnings per share over the last 5 years is growing at 10% on average, and the government of India 30-year yield is 7%, then the margin of safety is 3% effectively. Now, high earnings yield is just another way Graham is saying buy low PE stocks. But there is a nuance to this. In today's environment, simply listing a number of stocks and buying them based on the lowest PE is simply not going to work because if it was that easy, we would all find it incredibly easy to become wealthy through stock picking. You also have to consider, of course, its intrinsic worth, its ability to grow in the future, its cash flows, and a number of other variables in your valuations and fundamental analysis. But I wanted to just introduce this concept today. And if you want to get started in practicing margin of safety in your own workflow as you analyze companies, I found a calculator online. It's by Phil Town. He's a finance educator that I occasionally follow. And so his calculator makes it easy to start thinking about margin of safety in your own investing endeavors. Of course, if you want to go deeper into margin of safety, there are many other methods to calculate this, and there is no one method that's right or wrong. You have to pick one that makes most sense to you and also gain the wisdom from others who are more experienced than you in this. Of course, as you dive deeper into this concept, you will notice that there are many methods people use to calculate margin of safety. But whatever method you choose, when calculating numbers that are important in your analysis, always leave yourself room for error. That's the lesson that I've learned and discovered and wanted to share in this video. So for example, if it's the earnings per share growth or the sales growth rate, you don't know everything that may or may not happen in the future. So always leave room for error. In the investing business, losing money is inevitable. But as intelligent investors, our responsibility is to ensure that not all of our capital is wiped out in the process. And that is exactly why margin of safety is the cornerstone of intelligent investing. I hope you got some value out of this video. If you did, please hit the like button and subscribe to my channel, and I will see you next time.